Most financial advisors emphasize diversification when they talk about managing risk. And this can be fine to the extent that, yeah, I would never encourage somebody to only own one stock or something, right? Like, don't put all your eggs in one basket. Makes sense. The problem is that diversification tends to fail when you need it the most. You can look back at pretty much any financial crisis, and what you're going to see is that the value of almost every asset falls at the same time. So to that end, diversification kind of fails. I'm Stephen Neely, certified financial planner with Fortress Capital Advisors, and in today's video, I'm going to provide you with 4 practical ways that everyday investors can manage risk in their portfolios. I'm going to give you some of the drawbacks to these methods so that you can be fully aware of the trade-offs. And then I'm going to finish the video by giving you one strategy that I would use if I didn't have access to any other methods at all. And I'm going to break this one down in quite a lot of details. So if you were inclined, you would at least have a good idea of where you would start. So the first strategy I would consider using for managing risk in a portfolio is investing in gold exchange traded funds. Now, why gold? Well, so gold is widely considered a safe haven asset. It is one of the few financial instruments where you literally have millennia of data. And what it shows is that gold does quite well in a couple situations. One, when there is a great deal of uncertainty or panic, gold tends to keep its value. And 2, when there's a lot of inflation. Now, I know what Warren Buffett says about gold, but keep in mind there are plenty of other really successful investors who use gold in their investment strategies. And if you care about protecting your portfolio, it's something that you should consider, and it doesn't matter what so-and-so says about it. Quite frankly, it has a lot of attractive qualities that you care about as a diversifier for your portfolio. Let me talk a little bit about the exchange traded fund. So an exchange traded fund is basically a pooled investment vehicle where they take the money and they buy a lot of the underlying assets, and it trades on an exchange just like a stock trades on an exchange. And so in this case, they're buying physical gold and they're storing it. You've got very nominal fees to for management and maintaining the assets, but by and large, these gold exchange traded funds, they track the price of gold very closely, and you don't have to own the physical gold yourself, which is great because we just care about this for our portfolios, not actually hoarding gold. So, the gold bugs out there, they're always going to tell you, don't own a gold exchange traded fund, only own physical gold. And sure, if your view is that the end of society is nigh and we're going to live in some type of Mad Max scenario, you probably want to own physical gold. But I would tell you, you probably care a lot more about owning guns and water and antibiotics and all of the doomsday prepper things. I don't know how far gold is going to get you in that world, but for our purposes, all we care about it is for the attractive properties that it provides for our portfolios, and let's hope that we avoid the Mad Max scenario. Number 2, hold cash. So I had a video, a couple weeks ago, and I was talking about, using a really simple strategy of just holding cash and then the rest of it in a low-cost index fund. And so I kind of extolled some of the virtues of cash there, but let me kind of repeat some of these for today. So there's a huge psychological benefit to knowing that, hey, I've got a year or 2 of expenses here in reserve. I can withstand any kind of market crash that comes my way, and it's a security blanket for you. And there's nothing wrong with that. And I get it. Holding too much cash is definitely a drag, but a worse drag is making, really bad investment decisions at the bottom of the market and selling out and then missing out on a rally, which is to be even worse. And so I'm not suggesting doing anything crazy, but having cash reserves can really help manage risk because it means you will live to play another day, which should be the goal. Number 2, and people don't think about this a lot, but cash provides optionality. The other side of the coin is you've lived to play another day and you have cash, and now all of a sudden all these stocks that you love, whatever they are, they're on sale, and you can come in and buy them for pennies on the dollar while everybody else that was fully invested has no ability to do that. Number 3, use stop loss orders. So a stop loss order is something that you put into your brokerage, and what you say is, when this security reaches this price, I'm going to automatically sell it. So to give you an example, let's say you own a stock. It's trading at $100 and you want to limit your losses. Well, you can put a stop loss order in there for $90. And so when that stock goes to 90 or below, it's automatically going to execute. It's something that you're not going to have to sit there and worry about making the decision on your own. It'll take care of it for you. I do want to emphasize you need to spend a lot of time learning about the different types of orders. I would probably encourage you, instead of just using a straight stop loss order, use something called a stop limit order. And the reason is this, like let's say that I do want to protect losses and there's a stock and I want to get out at 90. But sometimes some crazy things happen and that stock might open up at 85 and then bounce right back up and go back up to like 95. For whatever reason, there are even like market glitches. And what's going to happen is it might blow past 90, never even touch it, go to 85, you're automatically going to sell, and then it's going to bounce back up. You need to be aware of that flaw. If you set a stop limit order, you could say, okay, the stop order starts at 90, and then I've got a limit order for 85. And so what that means is I'm going to only sell at 85 or above, and if it goes below 80, I'm not going to sell. I just want to provide some education. Anything I talk about in these videos should be, for educational purposes only. You need to do your own research on this. The second point I would make in using these stop losses is think about very clearly why you want to use it. I think they're much better for protecting against owning a losing stock than they are for protecting against a major market crash. And I'm going to tell you why. So one way that investors always shoot themselves in the foot is they own losers too long. And there's an idea in markets, it's called momentum, and basically it's strong stocks continue to get stronger and loser stocks continue to lose money. Investors hang on to losers way too long, and once the tide is turned for a stock, they might lose 70-80%. Happens all the time. I've done it to myself, and you keep talking yourself into owning this thing, and it's actually a real turd. And so stop losses are a great way to prevent yourself from owning a portfolio of these turds. It's a way you can just automatically sell and move on. Number 4, use trend following strategies. And so this is the one that I talked about at the beginning of the video. If there were only one strategy I could use and I couldn't do anything else, this is the one that I would use. And so what is trend follow? Well, it's an investment strategy that involves buying assets that are rising in price and selling assets that are falling. In short, you're trying to capitalize on market trends. We find these are highly effective for both reducing losses and for beating inflation. Those are two areas where these trend following strategies really excel. It's funny because you tend to see a lot of market purists and what I would call even zealots make statements like, well, that's market timing and market timing never works. Their critique really doesn't make a lot of sense. When you talk about trend following, this is unequivocally false. Dozens of studies show that trend following is an effective means of, like I said, managing risk and beating inflation. And I'm going to talk about some of the results here in a little bit, but I would encourage you not to be a zealot either way, right? Thinking that you are going to outperform the market all the time, or that the only investment strategy you should have is diversification and do nothing else. If you care about results and achieving goals, you need to be practical, open-minded, and evidence-based. And you do need to understand there's no free lunch, right? And there are definite trade-offs to trend following, but I find they're really worth it. And we're going to talk about what some of those are. Where these market purists and zealots are correct, I will tell you right now, I don't know any strategies that you can consistently pick market tops and bottoms. And a lot of people are kind of in search for that type of holy grail. And so that's where I agree. You're not going to do that. But that's not what we're talking about here. We're talking about changing your investments to manage risk. And there's plenty of evidence to suggest that's a good strategy. I told you I was going to give you an example of how trend following works, and I'm going to make this as simple as I possibly can. Let's start with the S&P 500 index. We use the S&P 500 price index, and what you're going to do is you look at the closing price on the last trading day of the month, and you go back to 12 months prior, and you simply say, is today's closing price higher than it was 12 months ago? If it is higher, you buy the S&P 500 index fund, as low cost as you can get. If, on the other hand, the closing price is lower than it was 12 months ago, you simply go to cash. That's it. Pretty simple. Now, let me kind of show you some of the results, and then I will, get into the pitfalls and some of the trade-offs, because there definitely are some. Okay, so this is the performance summary, and where it says moving average model right in the middle there. Those are the results from the trend following strategy that I just described, and on the right, that's the buy and hold. I would point your attention to a few things here. Number one, this goes back to 1978 all the way through the middle of 2024. The software I use didn't have a simple way to go back beyond that. And so 78 is where it started, but trust me, there are plenty of studies that go back way further than that. A few things to point out. Number one, look at the ending balance. Okay, the buy and hold model did actually end up with more money over time. So there is just a definite trade-off in general. But remember, we're talking about managing risk. Is this a successful strategy for that? And I think you're going to see that it is conclusively a good strategy for managing risk. Number two, the annualized return, the compounded annual growth rate, that CAGR, you've got 11.3% versus 11.8%. So, the total ending balance, even though it was only 0.5% a year, it does add up over that many decades. But in general, you do capture quite a large percentage of the market return. And so what we're really going to find out is, can I capture a large percentage of the upside and a much lower percentage of the downside? And that's going to kind of tell us, is this successful? And so here we go. The worst year, that's the first one I highlighted. You're down 12%. Versus the buy and hold portfolio, minus 37%. You took on less than a third of the loss in a calendar year. The maximum drawdown, you were down 23%. The buy and hold was down almost 51%. Again, huge gap. You captured less than 50% of the market's loss. You captured 90% of the compounded annual growth. To me, that seems like a pretty good trade-off. We look at the historical drawdowns during these, quote unquote, stress periods. And all this means is the maximum loss peak to trough. They start with the Black Monday, and then we end with COVID here. And what happens is you experienced roughly 12% loss, while on average during all these periods, the market was down almost 28%. So that's roughly 40%, which again, excellent result. Let me move on to this slide. Here you have all of these modern portfolio theory statistics, and I don't want to get into the weeds on what these are, but basically there are different ways to measure risk-adjusted returns. The emphasis I want to make is, once again, across the board, every single one of these stats is in favor of the trend following model and not the buy and hold. Pretty excellent no matter which way you look at it. If you look down towards the bottom of this slide, what I think is really cool is you've got this upside capture ratio and downside capture ratio. And I want to explain a little bit of this. This is saying that on average, I think over every monthly period, you are capturing about 71% of the market's upside, whereas you're only capturing about 60% of the downside. So you've got that 11% gap in there. This is something I really look at when I'm evaluating strategies. The financial services industry constantly comes out with these new products. The flavor du jour these days is buffered ETFs, but I gotta tell you, these things are garbage, at least from what I've seen. And one way I evaluate them is I look at this upside-downside capture ratio, and usually the downside capture is higher than the upside, which is exactly what you don't want. Because if you wanted to manage risk and you wanted to take less downside than the market, all you have to do is own some cash. You don't want to capture less. You don't want that ratio to be flip-flopped, or else it's a very poor strategy for you. And a lot of people don't seem to grasp this. And there's all kinds of products like that, the long-short equity and market neutral. And I could go on and on. But for the trend following, this is very much in your favor, and that's great. And just to be clear, If you look to the right where it shows the upside capture and downside capture of the buy and hold portfolio, it says 97 and 95. Why that's not 100%? It's because the benchmark used here was the total market, meaning thousands of stocks that included small company and medium-sized company stock. It's a little bit different than the S&P 500 that we're comparing, which is really kind of the largest 500 stocks. Now, let's talk about some trade-offs. Number one, you've got trading costs. What I find when I use longer periods like 12 months, the trading costs are quite minimal. If you look over time, what's happened is trading costs have shrunk quite a lot. So to me, this is something that's easily overcome. There are other strategies that have far higher turnover, and that's really going to eat into your profits. But in this case, it's not that big of a deal. What is a big deal, however, are the taxes. And so if you're going to do a strategy like this inside a taxable brokerage account, you better really weigh the costs of the taxes, because that might completely wipe out both your profits and the benefit from managing risk. This is far more suitable for putting in a qualified account like a 401k or IRA or even a Roth. The last trade-off is that this is a slower moving signal. And so if there's some sudden disaster like a nuclear bomb goes off in New York or China and the US go to war, markets are going to just get pounded, and you are not going to be able to get in front of that with this signal, because it's going to take some time before you would get the sell signal, and at that point it's probably going to be too late. Which is why this isn't the only thing that I use in a comprehensive risk management strategy. We're going to go into a little more depth in some of these trade-offs, just because I really want you guys to be aware of what you're getting into if you pursue something like this. So this chart shows the drawdowns, which means maximum peak to trough loss over this entire time period. The green represents the stock market and the blue represents this strategy. And right away, what you see is, by and large, this strategy had much shallower losses than the buy and hold strategy. But that wasn't always the case. Right? It definitely didn't have the deepest ones, but sometimes this strategy actually performed worse when you talk about some small drawdowns. So that's something that you need to be aware of. It's very easy to look back at different investment strategies over many years and just look at the averages and think that's what you can expect. But on a day-to-day basis, any trading strategy that you go into can behave very differently and have periods of underperformance for a long time. So before you commit to anything, you need to be very aware of those types of drawbacks, because you don't want to go through a shallow period of underperformance and then just abandon the strategy, probably right before you need it the most. I'll give you guys a little bit of insight of what you think about when you evaluate a strategy like this with statistics. In stats, there are a couple of major errors for any model. They're called type 1 and type 2 errors. If you focus on reducing type 1 errors, that means you're going to have more type 2 and vice versa. This particular strategy is pretty susceptible to type 1 errors. And what that means is it's susceptible to something called a false positive. This strategy might tell you, hey, it's a risk-off environment. You need to go to cash. And actually, it wasn't a risk-off environment. The market went down and then it rallied back up hard and it kept on going. And so you went to cash, you missed out on upside, and that can happen. That's why for us, I use something called an ensemble method, and we use lots of signals together. We found that we've got a much higher accuracy and far lower incidence of these type 1 errors. Now, what you really want to avoid with a risk management strategy are the type 2 errors, and this one's pretty good at that. So type 2 means a false negative, and what that would be is it's going, hey, nothing to see here, nothing to worry about, and then oops, you've got a 50% loss, and the model told you to stay invested for that. You absolutely need to avoid that scenario. This has done a great job of that for these long drawn out bear markets. And so that's why in the beginning of the video I said, if I could only do one thing, I love this strategy the most. But, go back to what I said earlier. And that's why I'm giving you 4 different ideas for how you can approach managing risk. And a couple of those were diversifying, owning some cash, owning something like gold, a safe haven type asset, because Even though I love trend following, it's actually not going to protect you in every type of situation. And so you need to think more comprehensively. I want to say one more time, everything in this video is for educational purposes only. I'm going to leave a lot of links for research papers on managing risk that I would encourage you to check out on your own before you do anything. I hope this is just a starting point for you to look at. But you need to evaluate your own situation. If you like this video, hit subscribe. I make videos on investing and retirement every week. Take care.